Hi, Warren William here from Smarter Saver. Quick definitions continues. Annualised rate of return. How should we look at annualised rate of return in assessing possible investments? Let's go to the video and take a quick look. The cumulative returns divided by the number of years annualised as a percent gives the annualised rate of return. This offers investors to be more objective regarding their future return expectations. An annualised rate of return can be calculated for any investment, for example a stock or a mutual fund. The calculation gives the average percentage return an investor would have received each year for that investment. Now, standards in the investment industry prevent short-term performance being annualised. For example, quarterly returns cannot be annualised. The one-year annual performance over a year of a mutual fund or a stock can vary widely depending on the securities markets, the economy, and the specific investment strategy. The idea in annualising returns is to allow investors to be more objective in comparing the differing returns of investments over multiple periods of time. In closing, 3 quick bullet points regarding annualised rate of return. The calculation is quite simple. It's the total return over the period divided by the number of years in that period expressed as a percent. It allows investors to have some return expectations for the future based on what has been achieved in the past. Thus, investors can be more objective when assessing a potential investment. But of course, past returns is no guarantee for future returns.